Let's take a step back. In 2025, gold and Bitcoin are no longer rivals. One carries centuries of trust. The other runs on code and liquidity. Both are now used as anchors in uncertain markets. Gold hit record highs. Bitcoin set fresh peaks. Different assets, shared purpose.
You're watching the Crypto Asset Post. Every week we cut through noise to bring clarity on crypto, policy, and what moves markets. From market shifts to central bank policies, from strategies to regulatory updates, this is your global lens on where crypto, politics, and business meet. Fast, sharp, and always practical.
Gold broke $3,500 an ounce. It rose on Fed cut expectations and fiscal strain. Central banks remain net buyers, especially in Asia and the Middle East. In the second quarter, demand hit 1,249 tons. That's worth $132 billion. ETF drove much of the flow. London is testing digital pooled gold. It could make bullion easier collateral. In short, gold's rise is about policy stress, steady central bank demand, and new ways to trade it. The April 2024 halving cut supply growth again. Bitcoin reached a new high around $125,000 in August. Spot ETFs changed the game. BlackRock's IBIT alone holds over $80 billion. Liquidity is deeper. Spreads are tighter. Institutions can now access it at scale. In Asia, Hong Kong launched new spot Bitcoin and Ether ETFs this year. So, Bitcoin's momentum comes from scarcity, ETFs, and growing global adoption. Do they move together? From 2022 to 2024, gold and Bitcoin often moved together. In 2025, they decoupled. Gold gained while Bitcoin slipped in early spring. Gold acts as ballast. Bitcoin adds torque. Custody is different. Gold relies on legal precedent and regulated ETFs. Bitcoin offers both ETF access and 24/7 self-custody. Asia shows both trends. Emerging markets buy bullion. Hong Kong opens regulated crypto gateways. The point: gold offers stability. Bitcoin adds speed and leverage. Tokenized gold is now worth about $2.6 billion. PaxG and XAUT lead the market. It trades 24/7 and works inside DeFi. Gold can be collateral without leaving the vault. If London's wholesale pilots scale, gold may start moving like Bitcoin. Bottom line, tokenized gold is making the old metal act more like a digital asset. So what drives 2025? Policy and rates. Rate cuts with deficits push demand for both assets. Institutional plumbing. ETF pull flows into gold and Bitcoin. Geography. Hong Kong ETF expand access. Emerging markets add bullion. Market structure. In stress, gold hedges equities. Bitcoin reacts to liquidity and policy. Together, these forces keep both assets central to the 2025 playbook. This leads to three scenarios. First case, sticky inflation with shallow cuts. Gold benefits most. Bitcoin holds if real yields fall. Second, aggressive easing and soft landing. Bitcoin outruns gold. Gold stays core ballast. Or third, regulatory or credit shock. Tight rules hurt Bitcoin. Gold benefits first. In a banking crisis, both rally. Gold leads. Guardrails? Use a barbell approach. Gold for stability. Bitcoin for upside. Keep sizing modest. Institutions often hold low single-digit Bitcoin and mid-single-digit gold. Pick wrappers carefully: physical, ETF, or tokenized. Rebalance when allocations drift. Always check compliance on custody, tax, and reporting. The take. It is not gold versus Bitcoin anymore. In 2025, it is gold and Bitcoin. One stabilizes. One scales. One is the legacy hedge. One is the new liquidity rail. Together, they protect portfolios and keep exposure to the next financial layer.
You've been watching the Crypto Asset Post, where markets meet insight. If you found this useful, hit like and subscribe. We publish deep dive content regularly, so you'll always stay ahead of the moves that matter. This video should not be considered financial or investment advice. Markets are risky. You can lose money. Always do your own research and consult licensed professionals before making decisions.